Groupon investors need a group hug, and maybe the Daily Deal site can have a brand new business model offering group hugs for 50% off. Really, really awful news for the company. Shares plunging in early trading Tuesday, going to probably be near the all-time low for the stock, below $6 a share. The good news, Groupon's earnings did beat forecasts, but revenues were light, and the guidance for the rest of the year is not all that strong, and that is leading the few fans, I think, on Wall Street that thought that Groupon might be a good investment to really flee for the exits. People probably should have seen this coming. Groupon, let's be honest, it's an interesting company, it's a fun company, but it might be one that was better off being private. It doesn't really have what many people think is a sustainable long-term business model. So it isn't a huge shock that Groupon is maybe going the way of some of the dot-coms from the late 90s and early 2000s that eventually went under because they just didn't really have what it took to be a public company for the long haul. The lesson here for any investor, do not get caught up in any of the social media hype. We've obviously learned by now, Groupon, Zynga, Facebook, all these companies struggling as public stocks. The only one that's the real exception is LinkedIn. LinkedIn has more of a grown-up business model, if you will, because it's a diversified revenue stream. The other lesson here, Yelp, that stock recently plunging on news that Google was buying the Frommer's travel business. I think the lesson here is that for any social media stock, even Facebook, that people are excited about, it doesn't take much for Google, Apple, etc., a real tech company with lots of cash to just come in and squash you.